Well, Mish, hi everybody. Good to be with you again. We're going to be talking a little bit about risk management this morning. It's a subject that I come back to every now and again because it's probably one of the most important areas of trading. We've had markets which have been going absolutely gangbusters for a period of time, certainly in the first 3 months of the year, well, first 2.5 months of the year, I think I would say, where we've had some pretty good moves. I have to say that, I've had a particularly good start to the year. And then we tend to drop into a period of time when things go rather choppy, and those nice little trends that will make up the pips for us in short order actually do the reverse. They will chop an account to pieces. In fact, you tend to get what I think it was, who was it who referred to piranha attacks, with an account where you get a little nip out of your account, and you get another little nip, and another little nip, and of course you get enough of those nips, an account is going to deplete fairly rapidly. And we've had something of that effect during the Cyprus crisis, where we had sort of markets which did a gap, and then it sort of spent another week sort of finding its way back up to fill the gap, and then we get another fall, and so on. And we don't get any really, really big, strong follow-through. So that's really what I'm talking about today, is the transition that there is from one market phase to another market phase. And the problem, of course, is that if we're not a little bit light on our feet, then what we can find is that the market just chops us to pieces, and we're left sort of scratching our heads, sort of wondering what is going to be next. Right, no, Boyke, it's all part of what we're doing here, and we'll just get on to shopkeepers and indeed crossing the road. So what we'll do, we'll go and look at some charts, and we'll answer those two questions, and we'll address that absolutely right away. So let's just switch over to some charts. And what we should be looking at right now are charts of the euro. Let's just start off with looking at this 5-minute chart of the euro. This is this morning's price action, as we've seen it running on through. We've got a high this morning, and then we've got a low which has been put in not that long ago. Right, this low was put in, as you can see, around about 10:30 UK time, and there we are. So what we've got is a certain amount of chop that's been going on. Now, the first of those points there is that what can traders learn from shopkeepers? Right, well, shopkeepers, in order to be successful, are going to have a shop full of stock, and they've got to have stock which is two things. It's got to be attractive to the sorts of people who are likely to come into the shop. Right, let's just translate that over to the world of trading. We've got to find a currency pair or an instrument. It might be gold, and we might be into ETFs and so on. We've got to find an instrument which is going to be appropriate for us to trade. So consequently, we want it to be looking attractive to us in the way that the merchandise in a shop needs to look attractive, and it needs to be sufficiently attractive that the pattern is going to tell us that it's going to be the right sort of move. Now, there are two sorts of patterns on this chart at the moment. Let's just look at the left-hand pattern. This left-hand pattern, which runs from the change in the day there, that's 2200, and that's, well, we just had the clocks change, so that's going to be 5 p.m. New York time, and running right the way along here, we've got an attractive little pattern. It's a pattern that is running on through. We can just put a little line across, let's chop the end off it, and we can put another line, and lo and behold, we can identify that as being a nice little triangle or wedge. We've got a succession of higher lows in this pattern, which is suggesting that just maybe it's not going to go down any further, and then we get takeoff. So we've got a nice attractive little pattern there. Okay, so that's conforming to rule number 1. And price moves up very nicely, and based on the size of that triangle, the subsequent move was well worth having, and it would tuck away a number of pips. Now let's contrast that with what we've got just down over here that ran over the last few hours. Now over the last few hours we got a contrasting pattern. Now we could look at this and say, oh yes, well I can see what this is. It's a reverse head and shoulders, which is going to take off on the upside. Anything at the moment it hasn't actually done that. Somebody else would look at this little conglomeration of price action running over there around about 20-25 minutes and say, right, yeah, this is a reversal of the trend moving down, and it's going to move on up. Well, what actually happened, it did move up, but then it immediately moved down and went to a new low. Those people who sell new lows would have sold only to find that they were on the wrong side of the trade. And then, whoops, the thing just walloped straight the way on back up again. As it moved back up, breaking this little downtrend, no doubt some traders went long, only to find that at the region of the old high, prices come down again. So it is not a clean and tidy little pattern in the way that the one over there on the left was. So at the moment, what would one do? Well, possibly just stand aside until we get a clearer picture developing. Now, it may well be that this is going to go shooting on up. It may well be that it's going to go shooting on down. And until there is clarity, it might be a good idea just to stand aside. That then brings me to the second rule of shopkeepers. Now, if a shopkeeper has got to have attractive merchandise, and it's the right sort of merchandise for his clientele or her clientele, then they've got to make sure that they can sell it at a price which is going to be appropriate again for the clientele. And what is more important is that the shopkeeper has got to buy it right. Okay? The shopkeeper must buy stock right. Meaning the shopkeeper wants to buy that produce, that item or whatever it is he's selling, at as low a price as possible in order to maximise his or her profits. Now that's the secret to running a shop. That's the absolute secret to running a shop. And the secret then to trading correctly is to have the right patterns, have the right setups, but also to buy right, buy in the right place. Now what that dictates is that when we've got this neat little triangular pattern with a succession of higher lows, of bullish candles at the lows, and then we get takeoff, where do we buy? Well, there are a good many traders out there who want confirmation after confirmation after confirmation. So they'll look at the breakout and think, oh yeah, it's breaking out quite nicely, but let's just wait until it's gone up above the previous high. Now the previous high will be over there. And they'll see price just breaking above that previous high and think, right, no, we've got a bearish candle there. Now I think I'll wait. And then they get this next candle and they think, oh yeah, well that's a bit of a bullish candle, but there's still that bearish one. I'll tell you what, we'll wait until we get the breakout of that candle. Okay. Now that trader is still probably going to be dithering, because that trader will have probably read somewhere that it's a good idea to wait for a pullback before entering. So he's got his area or her area and he said, right, I'm going to buy after there, but I'm going to wait for a pullback. Now, unfortunately, the pullback doesn't come. But it does eventually come. We get a pullback just down here. And so that trader says, right, well, we've got the pullback. And what I'm going to do, I'm going to buy after, okay, after it breaks to the new high. And then the trader eventually summons up the courage to click the mouse and buys on the breakout and probably with a tiny little bit of slippage gets in at something like 128, 128 sort of 72, 3-ish, 71-ish or thereabouts. Now, that trader then rubs his or her hands with glee as it moves into profit, and then starts to develop sweaty hands when price comes back down below. And it comes down below, so that trader is now underwater and is losing money, and will have set, no doubt, a stop just underneath the consolidation low that got the trader in. Price then finds its way down with a neat little trick that happens in the markets all the time, which is called stop hunting, and this candle picked out those stops which were just underneath the consolidation, including our hapless trader who got in and has now taken a loss. Price then moves on back up, and at that level, and saying, well, we've now got the big pullback, and we'll then buy again at those highs, only to find that exactly the self-same thing happens again. So there we are. Now that's the wrong way to do it, and let's relate this back to the shopkeeper, who, let's say that the shopkeeper is selling beds. How about beds? Now, price of a bed, well, I suppose you could spend more or less any sort of money on it, but let's suggest that it's a £500 bed retail, and that's the sort of money that people in his shop are prepared to pay. He goes to various wholesalers, and what he can actually find is that he can find a bed which he can buy for £450, leaving him a 10% profit. By the time the customer has haggled, who wants a 10% discount, but they settle on maybe a 5% discount, and the customer actually wants a few legs for the bed as well, and he wants those to be thrown in, the poor old shopkeeper is not going to make any money on it. So what that shopkeeper needs to do, he or she needs to find a source of supply which is considerably less than £500. Wants to be finding a source of supply which is no more than around about £200, so that that shopkeeper can make a sensible profit on the trade. And it's just the same with trading. We've got to get in at the right place. We've got to buy right, and buying right is not waiting and waiting and waiting forever for confirmation, because every 10 pips that we wait for confirmation, we are reducing our profit by 10 pips, and we are increasing our risk by 10 pips. So the thing to do is to realize what is going on with a pattern such as this, and we want to buy right at these lows, or at least we want to buy in this pattern after we've got some bullish candles. Now we've got a bullish candle right the way back here. We've got another one as price moves up. We've got another one here, and we've got yet another one here. So the buying area is going to be in this zone, in this region. And the perfect buy is after the breakout, there is an initial pullback. It pulls right the way back very neatly and so often to one of these lines, and it then leaves behind a bullish candle. So the ideal entry is either somewhere within this pattern with a stop below, or indeed we wait for the very first breakout and pullback, and the buy is just there, with an initial stop which we're going to put just underneath. So we end up with an entry which is going to give us a very, very small stop loss, and it then enables us to actually get out of this trade more or less anywhere on this move up with a profit. Yeah, we'll come over to the Jappy in just a second. So by buying right, we're relaxed. We don't suffer from sweaty palms. The market can do whatever the market wants to do. We can then get our stop loss into break even. So as price moves up, we can move our stop to the break-even level, which is just under the last reaction low, and we can just run it on up. So as price subsequently goes higher beyond the next consolidation, we can just bring our stops up, and that now moves into a stop profit situation. And for those of us who take partial profits along the way, then we've got plenty of areas where we can take maybe half or a third or two-thirds of profit, and we can be sitting pretty with having taken a profit and then keep a part of the position still running. We then get a reversal on down, and the whole thing changes, and our stop will be taken out, and we can then just walk away from it and wait and wait and do what traders, this is the most difficult thing for traders to learn: waiting. Waiting. We wait until we get our next neat, nice, tidy setup, which might be as neat and tidy as this previous one just over here. We've got to avoid the frustration of feeling that we just must jump into every possible trade which is running, and we've got to wait for the best setups. Right, guys, well, that, Boyke, I hope that answers the question there. How does trading relate to shopkeeping? You've got to wait for the attractive setup, and what we've got to then do, we've got to buy at the right place. If we were fast asleep at that time, and depending upon where you are in the world, you may well have been fast asleep when that setup kicked off. And if we sort of come in an hour later to try and put the trade on, we've got to resist it. We've just got to resist. We've got to tell ourselves, just sit tight and wait. Because like Confucius said, it all comes to he or she who waits. Right, that's lesson number 1, guys. Right, let's move on then to lesson number 2. And lesson number 2 is a rule about crossing the road. I think we're going to switch over. We'll look at the Jappy in a minute, but let's just switch over to the Aussie. Oh, can you bear with me half a moment? Right, back with you guys. Apologies for that. Right, now, the Aussie dollar is a very good charting market, and it's a very good Fibonacci market. What I just want to focus on is a nice little setup that came yesterday. We're looking at the hourly chart. Now, traders and people crossing the road, well, what on earth can they have in common? Right, well, anyone crossing a road is in severe danger. They are at risk of being run over. Traders are in severe danger. It is entirely possible to wipe our account out, and more. And it can be done very, very easily. It can be done as quickly and easily as just stepping off the pavement to cross the road. So, a very clever chap came up with a green cross code for crossing the road, and may well have been probably not a chap, actually, I can't quite remember who it was, but it was taught to our children to look right, look left, and look right again. Now that applies in the UK, but if you're in the States, we've got to reverse it round, and you've got to look left, look right, and look left again. And for traders, that's the one that I like. I like the US version, where people drive on the right. The sensible thing to do is to look left, look right, and look left again. Now with traders, what on earth does that mean? Well, what I'm going to suggest to you is that the setup that came through yesterday, I say yesterday, on Friday, it's as if the weekend didn't actually happen for us traders. The setup came on Friday with this move on down, and we've got a trend that ran down for 3 and a bit days and has now been running up for 2 trading days. So there we were with a relatively quiet trading day there, waiting for things to happen, and by looking left, what we can see is this overall pattern. And this overall pattern set itself up as being a classic harmonic Gartley reversal pattern. Price came down very, very neatly to the 78.6 level. It did so in a neat little ABC type wave pattern, and then price eventually broke out. Most traders look right, first of all. Most traders think, oh, look at this, I can make hundreds of pips here. And what they don't really look at is the left-hand pattern. They get themselves carried away. They'll trade breakouts in the wrong places. They'll take new highs, they'll take new lows, which statistically has been proven is a losing strategy. So what the trader needs to do is to always look left and always be looking left, at what went on before. And in terms of trends, well, I always like to do the opposite of what the majority are doing. And the majority were selling the Australian dollar. And on the blogosphere, there were umpteen posts to be seen where there were all sorts of reasons stated why the Australian dollar was going to collapse. And collapse it did. We got some really, really bearish candles. Each one of these is 60 minutes as an hour. Look at that one. On down it went. We had a number of these, and the bearishness got greater and greater and greater. Now, whenever you can start to pick up on what is going on with the number of traders and what they're doing, and you see that they're selling like crazy, then it might be a good idea to actually just consider the exact opposite of that. Now, this little pattern set itself up. It's not a perfect Gartley. I mean, every now and again we get an absolutely perfect Gartley, like a perfect entry or a perfect pattern, but not all that often. So, where we've got a low at an area where we're looking left is in the region of a previous low, where we're most likely to get a reversal, and we get a higher low with a bullish candle, we're then looking potentially for the breakout. Okay? We're looking potentially for the breakout. And we get the breakout, it breaks this yellow line, it breaks the trend, and it also breaks above the very last lower high in this previous move. Now, we didn't know it was going to be the very last lower high. Price could have moved on down, but it didn't. The trend line break gave us the heads up. The fact that it moved up above on an intra-candle basis, the last lower high, is also further telling us we've got the heads up that something could be about to move. We then get the inevitable pullback, immediately followed by a very bullish hour, a very bullish 60-minute candle, because it completely engulfed not one, but 2 previous candles. We then get yet another little push higher above yet another of the previous lower highs, and we then get another pullback with a very neat little Hallmey break. So where are the entries? Well, the very first entry is right the way down here, and traders find that really quite difficult to take. So the somewhat safer one, or at least the one that satisfies that need in us to have confirmation and confirmation, is where we get the breakout and the pullback, and if we can get a bullish candle as we did just there, then we've got an entry. Now that entry would enable us to get our position on with a relatively reasonable stop, and as price goes higher, as it did on the changeover in the day, then we can just sort of move our stops on up, and away we go, and we just stay with it, moving our stops up to break even, and then eventually just going with it. Right, Windvogel, yeah, very, very good point. Very good point, absolutely. Jesse Livermore, Nicholas Darvas, and yeah, you know, I trade breakouts, but what I want to try and do is to get them in the right place. Now, the trader who trades new highs. Now, let's just look at the trend over here on the left. Let's assume, and let's just ignore what is going on at the right at the moment, because we're all sort of very neatly in profit with this one. But over here on the left, we've got a high. We've got a high. So price has moved up. This is a high. At a new high, then the trader can get in, only to find that so often price will do a very solid retrace. Another solid retrace. If that trader has got deep enough pockets, then yeah, you know, you can sort of weather the storm. And relatively, the stop would need to be somewhere where this lower white line is. So up it goes again, and we buy a new high. Stop is going to need to be down here. Provided that we don't mind running much wider stops, then yeah, you know, it can work out for us. But just consider the risk-reward ratio. If this distance is our risk, our reward on this particular trade was probably never going to be any more than 1 to 1. If we can find a way of getting in really early, our risk reward can be considerably higher. It can be considerably higher. And we've also got to bear in mind that markets are made up of a good many participants, and a lot of them would just work on the basis that they break to new highs, it creates a false break, and that break to new high is in fact a stop run. So certainly in my experience, it has not been a winning combination of trading new highs. Just blind. So it's all about, for me, minimizing risk and increasing the risk-reward ratio as far as we possibly can. And when the majority appear to be doing one thing, then that very often is telling us that the satisfying trade is going to be in the opposite direction to whatever the crowd are doing. Now, let's just consider this one a little bit further now. We've got a setup down here, and it's paid off. It moved on up. I actually got into this probably a little later than I should have done, but there we are. It was just a circumstances thing that got me in sort of fairly late, and on up it has gone. But what should we be doing right now? Well, you know, we're sitting on a relatively good profit, And what so often happens is that price will do what it did down here. It'll do a deep retracement. So on goes the fib grid, only to find that price has got up towards this 78.6 level. It actually moved up from hitting a 78.6, so the fact that it's now up in the region of another 78.6 is telling me that I should be very cautious here. So this region is a very, very good place to take at the very least half profits, because we could then get another reversal on back down. Right, good point, Boyke, good point. Yeah, I mean, every now and again, good many years ago in my youth, I was in the car selling business. And I remember that it was around about the time of a fuel crisis, and we were selling sort of relatively high value Jaguars at the time. And nobody wanted to buy them because they were gas guzzlers. And the only way we could sell them was to either find people who weren't worried about the cost of gas, the cost of petrol, or indeed we would have to discount them like crazy and lose money. I always remember one particular customer came in, he was a farmer, and he took a fancy to what was an XJ12. Now that's a very tasty car, but it consumed fuel at the rate of about, if you're lucky, you might just about get 12 miles per gallon out of this thing, if you were really lucky. And we couldn't sell it. And a farmer came in and said, right, he said, you ready to do a deal? And we said, no, can't possibly take your price. And eventually he came in, having looked at this car over several months, and he said, every now and again, he said, one of my cattle, it develops foot rot. And he said, there's only one thing that I can do. He said, I've got to take it directly to the abattoir, and I've got to just take whatever I can for it. He said, because I know that if that foot rot develops, it'll go up the leg, it'll get gangrene, it'll become diseased, and eventually, I'll have to take it to the abattoir. But will I get anything for it? No. He said, I'll have to pay them to take it away. And he said, look, mate, you're in the same position with that Jag. He said, I'll take it off your hands, but it's got to be my price. And he was right. So, as it is with a trade that goes wrong for us, what we've got to do, we've got to put the for sale ticket up, and we've just got to take whatever we can get, and we've got to take it real quick. We've got to take it immediately. When we've got a loss that we're sitting on, there's only one thing to do, is to take it and just take that first cut. And take it quickly and cleanly and move on. The worst thing we can do is to be sitting there waiting and hoping and wishing that it's going to come right for us. Right, now guys, time's creeping on, and who mentioned the Jappy Panfire? Let's look at the Japanese yen briefly, because the Japanese yen is something of a special case at the moment, in that we have had the various finance ministers, we've had all sorts of comments coming out of Japan telling us that they want a weak Japanese yen. So, who are we, humble traders, to argue the opposite case? They want a weak yen, and they've actually got a weak yen. As we can see, this move up in the US dollar against the Japanese yen since October, it's moved up very, very strongly indeed. But over the last month, the month of March, what's happened? Well, it broke to a new high. This is another classic case of buying new highs. Fine, buy the new high, but be prepared to keep putting up margin to hold the position. Why not just wait until it shows itself that it's going to turn the corner and turn on round. Now that may well have happened this morning. We may now, and you can see my sort of various indicators on here are telling me right the way down here we've got a 707. This is the auto fib finder which is just picking this up for me, and it's telling me that possibly we're in a reversal situation. Okay, we've got this down move. Right. That's been running, not all of the month, but certainly for the last few weeks. We've got a series of waves. We've got the wave pattern. We've got the fibs. It's not quite a Gartley, but it's forming the right pattern for a Gartley. If we then come down to the hourly chart, what we can see this morning is that after that really strong move on down, and that was a larger day than average, price then followed through this morning and then just stopped. We've then got a nice little bullish setup. Let's move over to the 15-minute chart and see that in just a touch more detail. We've got a higher low. We've got another higher low. So this may well be a move that will now go on up and shoot all the way up to 100 or 100 plus. But it may not. It may collapse on down. Now, if we were going to wait for a very clear breakout, what we'd have to be doing is looking at a significant previous lower high, and there was one on previous day's trading there, and we will be waiting for price to break above 93.40. Or what we could be doing is looking at our favourite oscillator, and mine is the value finder, looking on this one and using just a little bit of trend analysis on it, and we can see it's really pushed on down, and then in common with price it forms a higher low and it breaks out, and that happens just about here. Okay, and lo and behold, we've got a bullish candle, we've got another bullish candle. We know that's a bullish candle because it completely engulfs the preceding one. We then get another little opportunity just over here with a Hallmey breakout. So we've got entry 1, entry 2, and away we go. Now by getting in down here, as in the shopkeeper, buying at a very advantageous price, then if this does reverse and not follow through and come right the way on back down, well, we've got our stocks to break even and we're not worried. So there we are, sitting on this one at the moment with a stop at break even. Just bring that down a bit. Stop at break even, and what we can do is to take partial profits up here. So we can take profit, leave the other half of the position on, or part of it, at break even. So we've taken some profit, we've taken our reasonable bit of money for the day, and we're keeping a part of it on for the potential swing that could go up to 94, 96, 98, 100 plus over a period of time. But the key thing is buying right. If we were to wait until, say, 93.40, now it may well happen that it'll go through 93.40 and just keep on running. But more often than not, that would then be the completion of a 5-wave move, and we might well find that it retreats all the way back down to 93. whereupon we might get the collie wobbles because we'd be sitting on there something like almost a 50 pip loss, and we might just close it. So much better to have got in early, where we can be relaxed, and if it comes right the way back down to 93, it doesn't matter a jot, because we've still got our position on from 92, 80, 87, and we're quite happy just to keep our stop on half of the position down there, because we've already taken some profit. Right, so guys, that is relating shopkeeping to trading, and also using that crossing the road analogy of looking left. Okay, we want to look right as well. We want to see what our current position is doing, but we always want to be looking left. We want to be looking at previous patterns. We want to be looking at old highs where price is most likely to reverse, okay, and hold old lows, of course, and also keeping an eye on things like, whatever you use. There are those who use pivots. Very valid, very valid. In fact, some markets, particularly things like crude oil, pivots work extremely well. Traders pivot points, that is. I'm a Fibonacci guy. I use Fibonacci, and I use harmonics. That's my thing, and it works for me. So whatever works for you, do use it. But just keep an eye on buying right, getting in at the right levels, so that you get a much, much better risk-reward ratio, minimize risk, and always keep looking left for areas where price could well be about to reverse. Right, guys, well, we're just about on time there, and if you've any questions for me, fire them at me right now. If you want to challenge me on this stuff, as indeed one or two people have this morning, and that's great, wallop those off to me right now. But otherwise, do keep in touch with me, and be only too pleased to exchange emails with you from time to time. And as one of the participants here has mentioned, I do private mentoring, and would be only too pleased to do so. I have two main products that are available at the moment. Number one is the breakfast trader. Number two is the harmonic wave trader, and they both work together, and none of it's rocket science, but I do coach people. I've got a number of people that I do see on a regular basis, either through the internet or indeed face to face. Do keep in touch, george@clickevents.co.uk. And yeah, sorry, I've just had one person who's asked me about the GBP USD, and I will just run over time for a moment. We'll just take a quick look at cable, which has been really quite an interesting performer this morning. Right, let's go to the 240-minute chart. Note the high there. You see the 1-to-1, that's denoting a double top, and price didn't quite push through. Okay, so at a previous high, that's the benefit of looking left. Okay, that's the benefit of looking left. It decided to cave in at that point, and it left behind a shooting star. So let's come right the way down to the 15-minute chart. Look at this, another false breakout, another false break high. Price then just decided to collapse on down. Where you get a pattern that looks as if it really ought to be propelling price higher with stacks of momentum, and it does not work, then it's a good idea to look in exactly the opposite way. And this was the entry for the short as it just broke down here, and we've seen it run on down. Now this is one of these where we could take partial profits on the way on down, and here it is in the region of the previous low. Is it going to pick up support or not? Well, it's not managing to do so yet, and there could well be a break lower or indeed a snap back. But again, by getting in early with the short, it doesn't really matter, because one can take partial profits, stop to break even, and then we just wait to see where it will go next. But I think that we've got to be really quite careful with cable, because in common with what the Japanese want a weak yen, and the UK authorities, our various bank governors, chancellors, etc., really do want a weak cable. Anyway, guys, have to go right now. Many thanks for being with me.